The BlackRock Investment Institute made the correct overweight call on Japanese equities early. So where in Asia is it picking will grow next?
Nominal GDP in Japan is growing and growing quite fast. That's a huge change and a massive tailwind for the economy in general. You're also seeing at the same time a corporate governance revolution, I would say.
Japan has some of the best performing stock markets of 2024 so far, with the Tokyo Stock Price Index and Nikkei Index both up around 16% year to date, on par with the US Nasdaq and beating the S&P 500, that's up around 12%. In the Asia Pacific, it's a clear standout to Shanghai and Australian markets 3% growth and New Zealand's measly 1% year to date. And a sign that equities in Japan were priced cheap. More than 1,000 listed Japanese companies, including Honda and Mitsubishi, bought back their own stock at record amounts, with total share buybacks hitting a record 9.6 trillion yen last year, according to Nikkei Asia. While some corporates returned capital to shareholders, with dividends set to hit an annual record high of 15 trillion yen in the financial year ended March. But its currency, the yen, is super weak compared to the US dollar, close to a 34-year low. That boosts the value of earnings for Japanese companies, but could result in currency intervention from the Bank of Japan. The central bank has been at odds with other major economies. It's been wanting more inflation and wage growth. It's now raising interest rates after being in negative rate territory since 2016. Money has been flowing out of Japanese equities since then, but BlackRock bought in last year, and it's paying off. In this interview, its Chief Asia Pacific Strategist Ben Powell explains why and what he's eyeing next. Thanks so much for your time. Ben, lovely to have you back in New Zealand. Welcome back.
Great to be here. Thanks for having me.
Now, last time we spoke, Ben, we spoke about the opportunity that BlackRock saw in Japan. The Investment Institute has since doubled down on that conviction. Talk me through what you're seeing in Japan, how it's played out, and the growth still yet to come, you think?
Yeah, so there's more to come, we think. So you're right, when I was last here, we were talking very positively about Japan, and some elements of that have played out reasonably well. So I would pass the Japan story into three elements. Firstly, you can think of the macro. So Japan has had 20 or 30 years of nominal GDP being approximately unchanged. So that's quite dreary. You know, if GDP is the same number today that it was 20 or 30 years ago, that's now fundamentally evolved. Nominal GDP in Japan is growing and growing quite fast. That's a huge change and a massive tailwind for the economy in general and for equity markets specifically. So that's the macro picture, if you like. At a more micro level, you're also seeing at the same time a corporate governance revolution, I would say. And I don't use that term too often. I know strategists throw around the word revolution a lot, but I think this really is a revolution where Japanese companies, under significant pressure from authorities, are treating their shareholders much better. So that's an ongoing story. We should see, by the way, a lot of news around that in the next several weeks. It's annual general meeting season in Japan, so companies will give us updates on that. So I think the kind of micro story of Japan, corporate governance also evolving. And lastly, thirdly, you've seen significant tax reform. Don't worry, I won't talk too much about tax. I find it exciting, but I get that your viewers
I do too.
Might not.
Ashamedly.
So this is really working in terms of encouraging Japanese domestic savers who've got loads of money, I should say, Madison. So they've got around $7 trillion of cash sitting in bank accounts, which is a lot. And if authorities can create incentives, which they are, to make it more tax efficient, to put some of that money into equity markets, that could work. And this is very early stages, but we're seeing some of that happening. So that blend of a much better macro story, a corporate governance revolution, and tax incentives to make it much more kind of appealing for Japanese domestic savers to move from their bank accounts at the margin into investments is all pretty positive. So we think that's ongoing. And yes, as you say, we've doubled down on the Japan call. We are overweight Japan equities, still think there's more to go.
Am I correct in thinking that currently in Japan there's not much investment happening by Japanese people? Is that correct?
It's a little bit correct. So Japan has been, as I say, it's been pretty tough sledding for several decades. So what I think you're seeing now is a very slow, it takes time, but I think you are seeing an awakening of the reality from Japanese people that inflation's a real thing. So if you think about it, for 20 or 30 years, the price of your cup of coffee has not gone up. So you have not needed to worry about inflation. Indeed, it's probably got cheaper. So as long as you've had money in the bank staying the same, your ability to buy cups of coffee has gone up. Your purchasing power has increased. Now you have inflation in the economy for the first time in a generation or maybe even 2 generations. The need to have assets in your portfolio that at least give you a chance of keeping up with inflation is becoming more obvious. Now, Madison, that doesn't happen overnight, right? You don't go from a 20 or 30 year economic paradigm to a new paradigm and everyone just clicks their fingers and says, hey, presto, inflation, we need to change. It takes time, but I think you are starting to see some investment now, some change in that psyche very slowly. This will take years, maybe even decades, but you are seeing some evidence of a move out of cash into real assets, including equities, a little bit of real estate, but let's just stay with equities. So I would say you're seeing small early signs. I don't want to overmake that point, but a little bit. But as an economist, I think it's very likely we see more of that because the incentives are so clear. As a domestic saver, inflation is happening and you're going to have to reallocate to try and be more defensive, more resilient to inflation. It'll take some time, but I think we're going to see more of that in the months and quarters ahead.
It's so interesting, isn't it? Because Japan, and specifically the Bank of Japan, their central bank, has actually wanted inflation. They've desired it in their economy, which is very different stories to the places that we live down under. There's also the story of the yen being very weak at the moment. And I'm interested in your thoughts on that. How much of that is playing into your thesis? It sounds like from those 3 points you made, not much at all.
Not much, a bit, right? So it's true that Japan's got some amazing export companies, and if the yen's a bit cheaper, they're more competitive. So that's true. But it's not, to your point, Madison, it's not really the main thrust of our story. Our story is much more to do with the Japan economic renaissance. It's the awakening of the sleeping Japanese domestic giant. Obviously a huge economy, by some measures the second biggest economy in the world. So what we're more exhilarated by is the potential boom in Japan, meaning Japan in Japan, rather than Japan going out to the world. So if we do see an upturn in consumer confidence, as an example, where people are earning more money. I mean, wages have been flat for a long time. If people are earning more money, feeling a little bit wealthier, can start to spend a little bit more domestically and so on and so forth. That's the thrust of our story, is much more a Japan thing, which I'm not going to say is independent of the currency. The currency is important, but it's not really a weak yen thing that's the crux of our story. Our story is to do with this domestic Japan policy, inflation, significant change, and the implications that has for the economy and for markets.
How are you thinking about the weak yen as a potential risk, though? Because the Bank of Japan could, at this rate, come in with currency intervention.
Yeah, so the yen's definitely got weaker. It's kind of a running joke as to if I'm lucky enough to be on business in Tokyo, I'll see lots of people from around Asia. They're either on business or on holiday because it's a fantastic country. I don't work for the Japanese Tourism Board, but obviously it's a wonderfully cheap time to go and enjoy, and a lot of people are doing that. So there are benefits to a weaker currency, but there are also limits. So I think the Japanese authorities have done a pretty good job over the last several weeks of stabilizing the currency. It was depreciating, weakening a bit quick, and they've now managed to put something of a floor into the yen, so it's a bit more stable. From here, what's critical is Bank of Japan policy, and I think what we're going to see is a continued, very careful, they don't want to scare the horses, but a very, very careful normalization of interest rates, which means a little bit higher, but very slowly, very carefully, because to your point, Madison, the whole point is to what they call dispel the deflationary mindset. So what they don't want to do is accidentally hike a bit quick, and Japanese who've been used to 30 years of deflation say, hey, we're back to the old thing and so forth. So they need to be very careful. Yes, raise rates in line with a much more buoyant economic backdrop, but don't do too much and risk the change from deflation to inflation, which is the center point of the whole story, I think.
Return on equity on Japanese equities is pretty low. It's single digits at 9%, so not very high. What does it need to get to, or what do market valuations of Japanese equities broadly need to get to for the BlackRock Investment Institute to cash out and take some profits?
So the good news is, if I can put it like this, is it used to be much lower than 9. So life's often about the change in, not the level, as they say. So the change in has been rather positive over the last many years. So you can go all the way back to, sadly, the late Shinzo Abe, his 3 arrows. So back in 2012-13, his third arrow was really, it was about a few things, but it was about growth and creating a more kind of dynamic economy, including an approach from companies which would be more dynamic, I guess. So that's been around for a decade and more. What changed about a year or two ago was the Tokyo Stock Exchange, kind of amazing, worth reading around, I think. They got much more, aggressive is a strong word, but I think we can use it. They got much more aggressive in really encouraging their companies to do better by their shareholders. So what we're seeing, again, this takes time. It happens AGM by AGM. It doesn't just happen day by day, but we're seeing a much more efficient use of balance sheets. What does that mean? It means in Japan, many companies have got slightly strange cross-holdings of each other. They own loads of property, which maybe they don't need all of it, and they've got lots and lots of cash on the balance sheet. So if you were to see an unwind of those cross-holdings, selling of some of the shares of your other companies, which you maybe don't really need, a bit of disposal of some of the property, again, that maybe you don't need, and maybe using some of the cash on your balance sheet, using all of that for buybacks, dividends, this is what we're seeing. So the story over the last years has been quite good. That's accelerated significantly in the last 12 or 18 months in line with this more aggressive approach from Tokyo Stock Exchange in particular, and I think we're going to see more of that. So you're right, 9% is not, by American standards, is a low number, not a high number, but it's significantly better than where it was, and we think will continue on the upward trajectory, which again is a tailwind for equity risk.
Of course, Ben, the anti-argument to this thesis is that this is already priced in. And investors, as we know, are always looking forward. What's the next thing? I'm sure they're asking you, Ben, that they want to invest in. There's now talk of the China equity trade being back after a strong export print and talk of company revenue there is set to grow. What are your thoughts on that?
So China, of course, still has significant headwinds, demographics, geopolitics, and the property overhang is still a significant issue. So there's that. But as has been noted a few times, there is no such thing as bad assets, only bad prices. So we can look back a couple of months ago and look at China equity market a couple of months ago trading at something like 8 times earnings. It was just very, very cheap. So you needed relatively little good news. We got a little bit of policy support, not so much, but just a little bit. But it turns out that was enough to have seen a fairly significant rally in Chinese equities. So where do we go from here? I think it's absolutely critical that we see a bit more policy support. So we have a large political event coming up. They never tell us the exact date, but it's something like early July. We'll get the so-called third plenum. This is a big deal. So this is when China authorities will communicate mainly to their people, but we as market participants obviously will be listening with both ears. If there is a change of policy, tone and approach. And I think what's particularly important is property. For most people in China, as in many countries all around the world, one's home is the big asset, right? It's kind of all you care about. So if your house price is going down, it slightly gives you the heebie-jeebies and makes you reluctant to go out and spend money. So that's what we've seen in China over the last couple of years, is a very weak property market resulting in a collapse, again is a strong word, but a significant fall in consumer confidence and a kind of tightening of spending as a result. So if we can see more policy which can give more confidence to the housing sector, the property sector, that isn't just a big deal for property. I think it'll be a big deal for the consumer who've got loads of money. So Chinese consumers in aggregate have got lots of savings. Stat for you that savings rates in China are about 6 percentage points higher today than they were before COVID. And this is now 18 months after the COVID reopening. So it seems the Chinese are a bit anxious about life more generally. They've got the money. So if we can see, it's an if statement, but if we can see policy in a month or so's time at the plenum, which is more encouraging to property and therefore to households to spend some money, that would be good. For now, we're neutral China equities, as we try and balance all of these different things. But as the Chief Asia Strategist, I'm watching this very carefully to see if there is more support and therefore the potential for more to go.
I'm interested in how closely you're perhaps watching India, because India is apparently outpacing or going to outpace China. Goldman Sachs came out recently saying that India's demographic looks very similar to China's 20 years ago. They've said that the average age in India is 28, which is what China looked like in the 1990s. Obviously, they have some demographic differences, but their populations are growing and their contribution to the world economy and markets is not quite on par with that yet. Where does India sit in your ranks?
Yeah, we like it. So a lot to like, as has been observed. I think it was last year, maybe the year before, that India became the world's most populous nation. I think, if I remember rightly, they'd have a 6,000-year pause. They were the world's most populous nation. Then China had a brief 6,000 years of being number one. Now it's back to India. So swings and roundabouts, I guess. So yes, the demographic pyramid looks pretty good. A young labour force coming through, able to do more and more work. So I think when I think about India, we're constructive. I don't want to make this an economics lecture, but GDP is labor force times productivity. So we just talked about the labor force. That's pretty good. More and more workers coming through. But I still think an underappreciated part of the bull story is the productivity angle. So India is becoming much more efficient, unbelievable advances in technology, payment systems, many other parts of the economy, which have really, it seems to me when I go to India, it feels like India from a financial markets perspective, a kind of ease of doing business perspective, has moved something like 50 years in the last 5 years. It really feels like a different kettle of fish from where we were just half a decade or a decade ago. So I think, to your point, the population backdrop looks super encouraging. That's true and important. But I would double down on the productivity side, which when we're equity holders, that return on equity, that efficiency is obviously very, very important. So I think it's the efficiency gains brought about by technological advances and a more stable regulatory environment, such as we've seen over the last 8 years or so, which mean for us that there's more to go in India.
I know you're the APAC guy, Ben, but we've just got to touch on the US. Has its strength in markets surprised you this year, surely?
No, we've been overweight, so I guess we've called that one okay. And the AI megaforce is real and ongoing. It seems to us. So the AI megaforce has obviously been the driver, I guess, of the big market returns. We feel that AI enthusiasm is appropriate. It's an astonishing technology, I think, going to transform every facet of human existence really quick, by the way, but coming down to a more economicsy level. I think what's going to happen next is a couple of things. One, I think we've kind of gone through the wow moment. You know, everyone's played with the various large language models and recognized that this is something like magic. So I think what will happen now is we move from the magical moment into the very prosaic, practical implications for, do we have enough data centers? Do we have enough power? Do we have enough copper for the wires, for the power? So now I think what the market will move to is AI is a real thing, but it also has some very practical implications, for example, into power demand. And we as investors, we can think about the next stage, if you like, as being potentially the next leg of the AI story. So it's, we think that the megaforce, the excitement around AI, we think is completely appropriate. But maybe the kind of specific areas of focus for us as investors may evolve a little bit over time from the Magnificent Seven, the kind of technology providers, through to supply chain implications, and then maybe to some of the users of the technology who we think as individuals or as companies, if we can use this technology well, it should make us all more efficient and ultimately be good for shareholders. So the enthusiasm we think continues, but maybe the emphasis will slightly shift over time, which is something that we at BlackRock are focused on, is yes, the enthusiasm, but exactly where next in terms of where that enthusiasm could express itself in markets is something we spend all day, every day thinking about.
These long-term megaforces that BlackRock has put out are incredibly interesting. But if we look at the more immediate force on markets, it's rates still, and it's still the inflation story, so it seems. Specifically in APAC, but then also comparing that to other Western central banks, how are you seeing this cutting game playing out? The ECB's done it. Who's next in this corner of the world? I'm assuming it's not us, and I won't be offended.
Yeah, no, we wrote a paper, the BlackRock Investment Institute wrote a paper back in 2021 called A World Shaped by Supply, and we identified 3 megaforces. So these are the energy transition, the geopolitical, more complicated environment, let's say, and demographics. So demographics, it isn't just China, but China used to add tens, even hundreds of millions of workers to the global labor supply. China's workforce is now shrinking by 11 or 12 million every year. So all 3 of those together, we thought meant that the global supply side of the economy, the supply side of the global economy, was a bit tighter. And what that means is price pressure should be higher, and it means inflation is going to hang around. So that's been our view for a long time. The market's, I think, now starting to price that more appropriately in our judgment. And it means for policy, it's going to be very hard to cut rates. So the kind of the rate excitement that we had back in January seems 3 lifetimes ago, but back in January, the market was expecting nearly 7 cuts from the Fed. That was never our view for the reasons I've mentioned. Markets now moved, we would suggest, more in line with reality. And actually what's quite interesting is even as the market has adjusted and is now more, I guess, more hawkish, expecting far fewer cuts, the equity market has continued to do pretty well, even in the face of that tailwind. Now, to your actual question, Madison, who's going to be next? I think everyone's super keen to cut rates, so it's going to be data dependent. So where data is kind of soft enough or disinflationary enough that it gives policymakers the room to cut, I think they want to cut. So the Fed, I think, want to do 1 or 2, but the question is, are they going to get the data which gives them the kind of confidence to put it through. And I still think that's an open question. So yes, cutting, I think hiking is very unlikely. They want to cut all over the world because they perceive policy to be very tight or somewhat tight. But the data needs to behave, right? The data needs to behave and give us a month or two of kind of encouragement, and then you can see cuts. But I don't think we're quite there yet, either in this part of the world or in some of the bigger markets, the US and elsewhere.
And I've heard you refer to exactly this point before about the lightning and the thunder and the lag between the two. The lightning being the monetary policy and their desires to want to cut around the world, but the thunder being that actual economic impact on economies.
Yes.
Where are you hearing that thunder loudest at the moment?
So I think it's a phrase that people were using a couple of years ago, somehow it's fallen out of fashion. People talk about a K-shaped economy. I don't know if you remember that one. So K-shaped economy is the idea that people who are more interest rate sensitive, so if you've got a mortgage, if you've got credit card debt and so forth, then obviously higher rates hurt you. And I think we're seeing that particularly in the US at the moment. The lower end of the consumer economy is, I think, suffering a little bit in line with what you'd expect from normal interest rates. I think what has surprised, has surprised me, is the strength of the economy and the consumer overall. And I think what I've realized now is that a lot of consumers are just not interest rate sensitive. If you're a pensioner, you don't have a mortgage maybe, you've got savings, interest rates going up is good for you. You're getting more every month in terms of the interest that you're receiving. So what I think is clear in the US and maybe elsewhere is something of a two-tier economy where if those of us who are unlucky enough to have debt are having to pay more on the interest, but there's a huge cohort of people who don't have that issue. So I think now what I'm seeing is the thunder's there, the economic consequences of much higher rates is there, but it's having a disproportionate impact on those people or sectors or companies which have got the debt. But there are many parts of the economy actually which are very, very well to do. So one example, of course, is some of the big tech companies in the US. I mean, they've almost got more money than they know what to do with. So it's not obvious that monetary policy has any impact on them directly in terms of their cash position. So policy does work. I think it has had an impact, but that's been somewhat muted, I think it's fair to say, because of the balance sheet strength that you've seen from certain US companies and certain US households has been clear to see in the last couple of quarters.
It seems like the lightning was very flashy and bright, yet the thunder hasn't been quite as loud off the back of it. Is that a fair assumption?
I think that's fair. I think that's right. And I think there are reasons for that. I still would be careful, you know, raising rates 500 basis points, roughly, and thinking there will be no consequences, we would think would be a bit bold, minister. But definitely it's been muted. It's taken a bit longer to play through than we were expecting. That's true enough. And I think that is to do with the strength of household and corporate balance sheets. So we would still be watchful, don't get too complacent, but there are so many of these megaforces which are constructive, AI megaforce, we've talked about a few others, that's been more than enough to offset even a 500 basis point tightening, which is quite remarkable actually.
Any other macro thoughts that are loud in your head? I note that you're fresh coming back from New York from a BlackRock Investment Institute meeting and you haven't released those documents yet on what you've come out with. Can you give us an early insight?
Yeah, that's right. So it's an amazing kind of company to work for, you know, the world's largest asset manager by far. And a couple of times a year we come together with our 70 or 80 most senior investment managers and really think about the big issues of the day. So you're right, we've just had that. I'm trying to reflect and think about what are my main takeaways. I'd say a couple of things. I mean, as we look forward, obviously November the 5th already looms large, the US election coming further down the pike. So I think 2024 is something like the biggest year in human history in terms of number of people going to the polls. India is a big part of that, but this political risk I think is very important and is not going away. So the US-China tensions are structural in nature, they're going to persist. I actually think regardless of who wins in November on the US side, this is two great powers bumping into each other, and that's something that's going to continue. So that has obvious implications for nation states. Politicians are going to think how they have to navigate these new choppier waters. But I think that's also true for us as investors. We can't just close our eyes to political risk. Unfortunately, that's going to continue to be part of the investment landscape for years and decades to come. So exactly how we do that, exactly how we navigate the geopolitical environment, I think is very important. And of course, as we go into the big one later this year, fortunately or unfortunately, that's only going to become more front page news, I would have thought, and something we as investors need to be cognizant of.
If I look at the BlackRock Investment Institute's positions, it's still largely neutral. It was the same when we spoke last year. How difficult is it these days for even BlackRock to pick assets not only in equities but in fixed income to allocate to?
That's right. So our big calls, we continue to be overweight the US and Japan, as we as we spoke about earlier. On the fixed income side, investment grade we think is a little bit expensive, and developed market bonds we've got a bit more constructive of over the last several months. But you're right, some of these mega forces, they don't really apply so neatly to a single asset class. So the mega forces, by definition, if you think about geopolitics in the way that we were just describing, it's not like you can think about geopolitics and say, oh, this means I should be overweight or underweight this specific asset class. They're kind of bigger than that. So I think one of the implications of the mega forces is the need for investors to be much more granular, much more specific. It isn't, as it was during the Great Moderation, that era where we had very low inflation, very stable interest rates. It was kind of just an everything bull market, right? We didn't need to be so nuanced. Now, in a more challenging economic, geopolitical, policy world, we as investors think you're going to have to be a bit more granular, a bit more targeted at exactly what you want to be owning, so more targeted, and also perhaps, Madison, more dynamic, so taking decisions a little bit more frequently, reflecting markets that are more volatile as they reflect the more volatile economic and political background.
Well, because of that, you're a busy man. You're only in Auckland for 6 hours and you spent some of that time with us, so I appreciate your time today, Ben. Thank you very much.
Great to be here. Thank you so much.
Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.